I'm Charlotte McLeod with investingnews.com, and here today with me is Chris Temple, founder, editor, and publisher of The National Investor. Thank you so much for being here. Always great to have you.
Well, it is, Charlotte. Always a joy to be with you, and we got a lot to cover.
We do have a lot to cover. I was looking back, and our last conversation was all the way back in November. So things are looking a little bit different than they were then. I was thinking we could start with gold. We've seen a lot of gold price activity. We saw all-time highs. Of course, right now we're in a pullback, but even when we were talking in November, you told us we can't have these parabolic moves without a correction eventually. So let's talk about what we've seen happen in gold. What are the main price drivers that you're keeping an eye on right now?
Well, we certainly did get that correction, and I'm fearful it's not over yet. Worst case, we go back to 3,500 where the big breakout occurred last summer. I can explain why that might happen. I'm not saying it will, but I'm saying that it's a coin toss right now. The 42 to 4,400, I just about guaranteed, because we were taking money off the table as gold and especially the equities were reaching a high. But it's important to remember that a few things have changed substantially from what was driving this gold move last year. Number one, the big story really for the last couple or 3 years, and the biggest factor that was a tailwind for gold, was strong central bank buying. That has started to roll over. And with the whole global economy being trashed right now by the energy prices, the shock of supply in other parts of the world, Turkey is selling gold. Poland is selling gold. Other central banks are being rumored to sell gold. I don't know that we'll have net selling for all of 2026, but the big tailwind of strong net buying is pretty well gone. So that's the biggest strike against gold. Secondly, generalist investors, and I'm always saying this to my gold bug friends. You have your opinions, you're religious about it. I'm more of a religious gold bug than most of my gold bug friends, but I'm also practical about it, and realize that whatever my opinions might be about money and how we should be not having a Federal Reserve at all to talk about, let alone the one that we do have, what does the other 99+% of investors, what do they think? Because they're the ones that have to be on board buying gold and silver and everything else to validate what you think things should be. And the fact is that part of the market, which is the second most important investment driver for gold, has also been hurt. Number one, because we've gone from the idea late last year of the Fed aggressively easing monetary policy in 2026 to no easing at all, at least on the surface. Now, out the back door, the Fed is having to shore up the repo markets and things like that. But we're not going to get any rate cuts anytime soon. There's a better chance we're going to get rate hikes. And the Fed is really hamstrung because of the increase in energy prices. And look, we were already seeing inflation moving back up before the war started. Now it's just going to move up at a faster clip. So you got that problem. And then kind of a corollary, Charlotte, of that is that the momentum traders who, as they always do, they come in late on the moves for gold and silver. They get whipsawed and then run for the hills. Not only did they run for the hills because they realized they got whipsawed, but all of a sudden another play toy or two came around. And the traders that were chasing gold and silver are chasing energy and fertilizers and things like that.
Well, we've got a lot of pieces here to unpack when it comes to gold. And maybe we start on the negative side. You mentioned we could get back down to that $3,500 level for gold. I know nobody wants to hear that, or maybe they do in case it's a buying opportunity. But what scenario would it be where we could get there?
The scenario would be that the Fed stays on the sidelines, that the ingredients that have to come together for them to hold their nose on whatever the inflation rate is and just ease, okay, that goes away. Because right now you've got two major sources of, let's say, kryptonite that are hurting gold. One is the soaring energy costs, and we haven't seen the end of this yet. We're still in the beginning of the price increases and the supply shocks, which are going to be with us in various forms for months, if not a few years, even if this conflict ended tomorrow, which it regrettably won't. So that's going to keep a damper, especially on other economies. And look, Charlotte, a lot of the central banks that were buying gold in recent years had net foreign exchange reserves to do it with, or they reallocated some reserves. Simply put, they're just less flush to add to those gold holdings. And again, with a couple recent examples, they're having to sell to raise money. So that's a problem. So, you have to ask yourself, what's going to change that? And I don't think anything is right away. The other part of it that has to change for gold to be out of the woods, and this goes for most other metals as well, generally speaking, is that the Fed has to be in a place where they have no choice but to ease. And again, no matter what is going on, no matter what the inflation rate is, I love to remind people that one of the best times in this century to buy gold, and especially gold equities, was in the wake of the 2008 crash. Everything fell apart. Gold dropped by a third from its high, but it was the first thing off the map. And gold from the end of 2008 until the fall of 2011 tripled in price. Not because gold bugs were buying it, but because generalist investors looked at what was happening and said, okay, we've got an economy that's broken. All this Fed money printing and quantitative easing and so forth is not going to do anything anytime right away to resurrect the stock market, real estate, and the rest of this stuff. So by process of elimination and concerned about all this money printing just going into the ether without any economic benefit, that's why you had such a strong move in precious metals for that 2.5 years or so. And when the mining stocks early in 2011 peaked, and when gold itself peaked later in 2011, wasn't because the Fed stopped printing. It was because that printing was finally having some traction and getting the stock market resurrected again. The debt problems were papered over, et cetera. And so the generalist investors who went into gold said, okay, funds over here, we can get back in the stock market. So you're going to have to see somewhat of a mix of those kind of ingredients again. The fact that the stock market has not yet responded in a big way downward like metals have is amazing to me. And of course, we're always amazed that the stock market defies gravity. There's been a lot of pumping going on, but the energy prices, the interest rates going up, inflation staying sticky, no way the market should be where it is right now. And that's going to change. But again, until I fear, until we have a much bigger washout in the market and the Fed is forced off the sidelines and basically institutionalizes the idea that we all know already, that forget about their 2% inflation rate. It's a lie. It's been a lie for over 5 years. We're not going back there. If you average out inflation for the last 5 years, it's double their 2% inflation rate. And it's going in the wrong direction. So there will come a point where they have to panic. And as central bankers always do, you inflate away debt problems. You inflate away crises. And that's when the light will turn from caution to green again for gold.
All right. Yes, I've been asking people, what is the trigger for gold to start its next leg higher, and getting a variety of answers. But it sounds like there's really a number of things that have to come together at this point for that to happen. Does that sound correct?
I think there is, because again, we've already seen once again that just because we have a war or crisis does not automatically mean gold goes up. I said Sunday night, when the first Sunday night that the futures market opened after the war started, that you can't trust the initial knee-jerk pop higher in gold because there's too many reasons why gold's going to go down because of the war. All right? That's not going to help. It's going to cause energy to go up. It's not going to cause gold to go up. Again, bottom line, in my view, what causes gold to turn around is when the Fed has to stop pretending that it cares about inflation, that it can do a darn thing about it, and just starts going nutso again so we don't all go down the deflationary drain. That's when gold gets going again. And we're a little ways from that.
Yeah, I think that spells it out very well. And of course, we want to talk about what is going on at the Fed right now, because there's some very interesting developments. We have Powell on his way out. His term wraps up later this month, and we have Kevin Warsh on his way in. And there's a lot of discussion around what is Warsh actually going to be like as Fed chair. I know you've been following this really closely. So I wonder if you could break down what you're expecting, what you're looking at right now.
Well, we need to keep in mind, first of all, Charlotte, that the Fed is an institution and the system over which it presides, which is what's called a fractional reserve system or banking system, has accelerated for going on 50 years, the levels of debt, money supply growth, and all the rest. And we're really getting to the place, and the Fed, look, when Nixon took the U.S. off the gold standard in the 70s and unleashed Arthur Burns on the world, he was Nixon's Fed chairman. In the 70s, the inflation, the currency debauching, and so forth was still uniquely that of the U.S. The other central banks of the world hadn't really started doing this yet. Now everybody does it. It's a race to the bottom for all the fiat currencies. They've all, stayed in this debt trap. And as a matter of simple math, over time, you go from debts being unpayable to the place where we're at now, where they're starting to become increasingly unserviceable. The accumulating interest costs for so many countries and institutions and people is getting to be prohibitive. So that's the world in which Kevin Warsh is stepping in. When he first got nominated, I was joking at the time with some friends. I said, if this is supposed to be a yes man for lowering interest rates, on the surface, Trump picked the wrong guy, because Warsh's background is quite the opposite of that. And he has also said, and even repeated recently in his confirmation hearing in front of the Senate Finance Committee, that he thinks the Fed has had too heavy a hand in things, shouldn't have as large a balance sheet, et cetera. Now, one of the first things that's going to be fun to watch when he takes over as chairman is, what are you going to do about trying to lower balance sheet when the needs for debt financing and refinancing on a part of the Treasury are going up a net $2+ trillion a year on top of the existing, we'll use around number 40 trillion of existing debt. The Fed stepping back is a major buyer of that. Is not the stuff of interest rates in the market going down, but of going up, if the Fed's going to be playing less of a role. And that's why, and what I've said recently to everybody, and to yourself now as well, Charlotte, and our listeners, the most important policy stand that Kevin Warsh has articulated was basically not discussed at all in his confirmation hearing. I don't think anybody had brains enough to know how to even ask about this thing. But Warsh has made clear, and this is where, Elizabeth Warren, we all make fun of her, call her Senator Pocahontas because she claimed to be 1/1000th or whatever of Indian once upon a time. And of course, the president never lets her live that down. But she made the crack that he's going to be Trump's sock puppet. Okay. I don't know if you saw that characterization or not of hers directed to Warsh. Well, what does that mean, Senator Warren? Why didn't you tell us exactly how that is actually going to be true, in a sense? Are you just postulating for the cameras and the fix is in and you're not going to go in a sacrosanct area? Are you not smart enough to understand this? But here's what I'm getting at, Charlotte. Up until the late 1950s, or the early 1950s, I'm sorry, the Federal Reserve institutionally operated largely in partnership with the Treasury Department, where they almost, for oversimplification purposes, they co-managed monetary policy and the level of debt and the level of interest rates. What's important to understand about that is two things. One is that was the last time at the end of World War II that we were over 100% debt to GDP ratio because of the war. Now we're back there again. Secondly, there was a matter of public policy because the government, and this was the noble part of this that was told to the public, we want to keep even long-term interest rates and mortgage rates pushed down more than what the market wants, because we want returning GIs to be able to start businesses, get GI loans, buy houses, and things like that. Those were the reasons why the 100+% debt to GDP, and we want GIs to be able to start businesses and other people to start businesses and so forth. After that was over with, the Fed and the Treasury parted company, and I can't remember the name of the exact measure that it was, but that was what started in 1951 or two, the modern day, quote, independence of the Federal Reserve, where it single-handedly sets interest rate policy. Now look, it's still an enabler of this expanding U.S. debt. In fact, Jerome Powell likes to look and sound serious and like a professor and so forth. But here's a guy in 2 terms, 8 years as chairman, who presided over the worst consumer and producer inflation in over 40 years, and all by himself under his watch oversaw the federal debt grow $18 trillion out of the 40 trillion, again, rounding it off, total that we have right now. So this is not a guy who has done a darn thing to fight inflation. He has accelerated all of the different problems that we've got. And it's going to be interesting to see what Kevin Warsh does about it, what they're going to try and do about it. And they're not going to do this in time to forestall a bust that is looming imminently, in my opinion. We're way overdue for another 2008 type of thing. Maybe not as sharp. I think it'll be more drawn out, more of a slow, dull ache than a quick, sharp pain like we had in 2008. But math dictates that we have all of these bubbles that Powell's responsible for growing and fostering. And, you know, they really, when you go back to 2018 and 19, we were getting ready to have another blow off like 2008. And he was able to use COVID as an excuse to paper all of that over. So they did more buying of time, but math and gravity are both going to catch up. And, it's going to be interesting to see if Warsh and Bessent, the Treasury Secretary, are able to team up, make this institutional change again. And then are the markets going to embrace this notion of cramming down interest rates again, this time all the way across the yield curve? I'm not holding my breath that it's going to work.
All right. So that is definitely a point in terms of Warsh that I haven't heard discussed. So that'll be something to keep an eye on. I want to also bring up some of the points that I have heard people mention. I've heard a lot of talk about, well, he wants to look at inflation in a different way. And I think that's probably important to take a look at given the concerns that we have about inflation since the Iran war began. So is that something that you're keeping an eye on as well? How do you see it?
It's worth keeping an eye on, but it really lends itself to the fact, and I alluded to this a few minutes ago, Charlotte, that it's been an open lie that the Fed has a 2% inflation target. They don't. We're 3 to 4% based on their own already massaged numbers. And now Kevin Hassett's trying to be cute and use a certain formula that the Dallas Fed has to be even more disingenuous about what the true cost of living is. You know, when Powell gave his last press conference as chairman last week, and he commented incredibly. I mean, this guy, in a way, he's like President Trump and thinking he's got 100% approval ratings over the Iran war and the way he's running the economy. I got news for you. Consumer confidence numbers have been at record lows recently. Expectations for future inflation are at the highest they've been in quite a long time. So when Powell comes out and claimed, as he did last week, that he doesn't see any sense of the Fed's credibility being lost, I don't know what planet he's on. It sure isn't this one. And it's only going to get worse. And again, I think that with the existing level of debt, the increasing trouble with the government in financing it cheaper interest rates. I mean, as you and I are recording this, we've seen for the first time in months the 30-year Treasury creep back above 5%, the 10-year Treasury approaching 4.5%. And this is not the stuff of the Fed being able to lower rates, and it's really a reaction to the existing debt still out of control, President Trump told us he's going to do something about it. He hasn't done anything except enable ever more of it. Now he wants to increase the defense budget by by 50%, all in one fell swoop. We'll see what Congress says about that. So look, it's just a game of massaging numbers to try and hide the reality that Joe Sixpack and Sally Soccer Mom see, that the economy for them and, 2/3, give or take, of the U.S. public is already experiencing ever more acute stagflation. The delinquency rates for a lot of different things, subprime cars, credit cards, things like that, again, have been moving up. Some of them already above what they were in a financial crisis back in 2008. This is not getting any better. And the only legit way for the government really at this point in time to reduce inflationary fears is to put the brakes on massively on government spending. And Republicans, Democrats alike have zero intention of doing that.
Yeah, that was definitely a direction I wanted to go in, is your outlook for the U.S. economy in these circumstances. So you're thinking that we have a stagflationary situation that we're going toward or are already in at this time?
We're already in it, and it's going to get worse. The whole, when we extrapolate what's already gone on in roughly 2 months, just over 2 months now of this war. And again, as you and I are recording this, it's looking like it's going to get hotter again between the U.S. and Israel and Iran. And if it ended tomorrow, and a lot of people a lot smarter than me on the nuts and bolts of the global economy have been pointing this out repeatedly and regularly and almost unanimously, it's going to take months to years to restore energy flows, number one, to what they were before the war. Number two, we're also seeing the fallout of things like helium, like sulfuric acid, big in the uranium industry, of all different kinds of other products. I was telling a friend of mine just this morning that I was catching up with, hadn't talked to him while we were talking about, if you want to know how much fishing I've been doing recently, I said, I might have to start doing more because even the overseas cheap stuff in the store is going to get more expensive. Half of the fishing fleets in Southeast Asia, where they go out and harvest fish, they're not even out. If you can get fuel, it's too expensive. So even when it comes to the cheap mass-produced and some of the farm-raised seafood that you get in the grocery store, that's going to start jumping a lot more in price. Everything that China and others send to us are going to start jumping more in price. So this is all going to trickle down and feed inflation. And as Powell said last week, and in this point at least he was more correct than he usually is, yeah, it's tough for the Fed to respond to that. All you're going to do by printing more money is make the prices go higher still, because nothing the Fed does is going to change the physical realities that there's less oil, less fertilizer, less of everything. It's going to cause prices to go up. And the Fed learned this lesson in the 70s. Powell should have learned it himself at the beginning of COVID and didn't. Maybe he's learned it now. Maybe Hassett will carry this forward, that at the same time it's going to be tough for the Fed to hike rates politically and otherwise and contribute to an economic shock. At the same time, they're really in trouble if they lower rates and accommodate the inflation that they've already stoked. So they're in a lot of trouble. I mean, this is I don't know why this guy wants this job.
It's really a rock and a hard place situation there. So they can't really go lower. They're going to struggle to raise rates. How do you see then this Fed rate situation playing out in 2026? What do you think is going to happen there?
I don't know if it's going to play out this year, if it's going to be longer than this, Charlotte. We don't have it on here, but I think you may have seen recently my cartoonist, I had him do a cartoon of Jerome Powell. And on one side, you got the bond market vigilante looking like a cowboy with a revolver to his head. And on the other side, you've got the Grim Reaper, the credit crisis with this Grim Reaper scythe to Powell's neck. Both of them saying to Powell, do what I say or you're dead. So this is the choice that the Fed is going to have. They don't want to have to make this choice in an overt way anytime soon, because either way, there's consequences. But the bond vigilantes do not want to see the Fed surrender on inflation totally. They've already surrendered most of the way. and try and explain away why they're not raising rates, why they cut rates to the point that they have already when inflation has still been running half again or double their target. But under the surface, there's a lot of cracks appearing in credit. You've had a number of different private equity funds and private real estate funds. They stopped redemptions or slowed down redemptions because things are becoming illiquid again. So you got all these little miniature 2008s going on underneath the surface. And at some point, the Fed has to decide, do I want the bullet in the head or do I want the Grim Reaper to cut my head off? All right. And as always, think this bulletproof, when the choice is made, it's going to be in favor of the Grim Reaper. There will be no other way to go about it. And I've joked to friends of mine that if it gets really extreme in that sense, what you'll want to invest in will be wheelbarrows because they'll really unleash a lot higher inflation. But, be the first one to come up with the idea of selling wheelbarrows with your favorite sports team's logo, your favorite pop star, or whatever, the decals or logos in the wheelbarrow to carry your money to the grocery store.
Well, and that is definitely a direction I wanted to go in as well. I think people are really wondering at the moment, how should I invest right now? What should I do? The inflation is so high. We talked about how gold is likely to go sideways for some time. We've got all of these commodities that have been kind of drawn into the surface because of the Iran war that we wouldn't usually be thinking about. So how are you strategizing right now? How are you approaching it?
Well, I've had people raising cash going back to last fall, Charlotte. If you look at the peak of my own recommended portfolios for our members, we were probably 60% or thereabouts of an overall allocation was in metal stocks, precious metals, base metals, rare earths, uranium, all that. I lump it all together. Now we're not hardly 20%. And we did that by selling parts of most of my recommendations, but I've stressed that a lot of these are good companies for the future, that right now, frankly, you can start nibbling back in because a lot of really good names among exploration companies even are down by half from what their peak was. So you can start nibbling back in. Don't go nuts too much yet because, again, there's still some downside danger. Aside from that, you got to invest story by story. And when you've got a really good copper story, gold story, whatever it is, nibble a little bit now, wait a month, nibble a little bit more. Otherwise, keep a lot of powder dry as far as cash. And I do think that I'm telling our members to double down as far as ETFs that short the market right now, because this is not sustainable. And you've got to look at probabilities, manage a portfolio based on probabilities. The probabilities are global recession, stock market finally coming to grips with what's going on. Ultimately, gold and other commodities will recover when the Fed is forced to act. And gold will be first out of the gate. It'll drag silver along. Later on, it's going to take some other things for all of the metals and other things in a broad sense to catch up. But never forget, and I've said this many times, not to get too far afield or on a tangent, Paul Volcker is remembered for all the wrong reasons. He changed the natural order of the financial universe around the time that Ronald Reagan reappointed him after President Carter had first appointed him. And overtly on the surface, he tamped down the inflation and the currency devaluation and so forth that we saw in most of the 70s. But what he did after that was created the so-called wealth effect. And he turned the Fed not into a referee that would adjust interest rate levels and policy to govern the organic economy. But he turned the Fed into an institution that, as a first matter, creates the underlying economy. And this is why everybody these days is all, we're worrying about every syllable and jot and tittle out of Jerome Powell's mouth, and now it's going to be out of Kevin Warsh's mouth. It never used to be that way because the Fed was, again, it was a referee. It was not the one that created the economy. Now it is. And so that replaced the traditional business cycle, Charlotte, with what we've had since then, with greater extremes along the way, this boom and bust credit cycle. Because now that's what everything revolves around. And again, I'm generalizing this to make the point. And so what's important about that point right now is that, you had miniature busts along the way, but you had a big one in 2007. You had a big one in 2008. You had one looming in 2018 and 19 that the Fed postponed with all the COVID money printing. And here we are again. So understand that if they can't keep all the balls in the air again, and I think it's a matter of time and it's a matter of simple math and gravity, we get another washout where everything for a while goes down. I don't care what it is. Everything for a while goes down in value. And we've seen the beginnings of some of that. And incredibly, and it shouldn't be this way, we don't have to like it, but it is, it's been hitting the precious metals and other commodities, disproportionately. Yeah, save from oil and the things that have been acutely affected by the Iran war, when it should be impacting the stock market and credit and things like that. But that's coming. So again, right now you want to bet on that scenario, understand the probabilities of these things, and bide your time, because if you're a gold and silver bug, this long-term secular bull market is not over, but this is another rude interruption that's been another wake-up call for some, that you can't ever be too religious about any sector and overstay your welcome.
I think definitely that it feels unsustainable for the broader markets, and that helps explain your strategy right now of, some caution, but maybe picking up things that look good at the moment. One point I wanted to raise as well before I let you go, I'm seeing questions emerge about how inflation may impact the mining company stocks. So, of course, the actual miners, they benefit from higher metals prices right now, but we have this inflation that seems to only be set to increase. So does that concern you at all, or how do you see that playing out potentially?
Well, I would say, Charlotte, it concerns me. The characterization I would make, though, is that it's something that is one of the ingredients you look at, especially if you're looking at a company that's in the exploration stage. Now you've got a resource. What is it going to do to the economics? Are the prices going to be strong enough to weather what's going to be every time somebody does an updated PEA, for example, the cost is 20 or 30% higher than it was 2 or 3 years ago, because fuel is going to be more, labor is going to be more, all of the inputs are going to be more, and so forth. Of course, for gold producers, they're in Fat City, because I don't care who it is, unless you got a really, really, really crummy project. You're doing really well, even with higher costs. I'll use the example, and just one of many on my recommended list, but look at Integra Resources. I visited their Florida Canyon along with several other projects when I was out in the Southwest U.S. recently. When that company bought Florida Canyon, it was a project that had changed hands numerous times over the years. Small grade, not very sexy. The only sin in life that it had, the big one, was that the gold price wasn't enough to make this thing work. And I remember, and I'll always tell a story, when George Salamis told me he had just bought that and they were looking at how that was going to fit into Integra's overall plans. He said that if gold stays around 2,400 an ounce or better, this will do what we want it to do. It'll kick off a little bit of cash flow, help us finance other things. And instead, they got almost double that number last year out of it, and the company's swimming in money and accelerating other plans. And this is something that, for those that understand gold, and gold mining is a heap leach operation, that the stuff they're running is under 0.3 grams per ton, which at 4,000 plus gold is awful darn nice. So, but you're right. Your point is very apt, and that inflation is going to hurt the mining industry. I think that a lot of the base metals and other stories are going to require greater scrutiny now. There was just a high-profile story in Arizona of a company that came out with a PFS that the numbers were atrocious. Part of it because of this big move up in costs. So that is going to have some impact on this. Broadly speaking, as I know you realize about me, I'm still a long-term broad commodities bull. We've seen bullishness and fits and starts in individual places here and there in recent years. You had big moves in, lithium and nickel and cobalt, and then they got too hot and they crashed back down. Now it's been rare earths, and it's tungsten, and it's going to be zinc. Magnesium is a cool story that all of a sudden I've been getting my head around, because that's going to be the next fad and hot metal that's got increasing uses in industry and in automotives and so forth, and nobody's paying any attention to it. But I added a company recently, Inman Mines, that I think is it's a flyer, but they've got a big Japanese brother now that's going to help them with their project in BC. So that was one of the things that pushed me over the edge there. So those are a couple examples, Charlotte, where you can still be investing money for the long term in individual good stories that you vetted, or for, that I vetted or somebody's vetted. But sector wise, everything is still very, very murky right now.
Yeah, I think that helps drive home that case by case basis. And interesting to hear about magnesium. I can tell you that's the first time I've heard somebody mention that to me, I think in a very long time, if maybe ever. So great to go into that. And I'll let you go. I think this has been great at surfacing a lot of points that we haven't talked about here before. Any final thoughts that you would leave investors with before we say goodbye?
Again, I think that right now you can't be dogmatic about anything. A lot of things are not in our control. The Iran war is a part of a reorganization of the global order that we've had since the end of World War II. It's only beginning. And I've commented before the Iran war that in my view, we were already in a World War III over commodities and currencies. And that is a part of this whole thing with Iran that is now accelerating. The chessboard is moving around. I don't know how to play this game of chess. I'm not ashamed to say. And so we look at probabilities. You've got to be cautious with your portfolio. And again, it's at times like this. And this, frankly, is a lesson that precious metals investors that got too overly exuberant learned again the hard way. You don't ever have a huge bet on any one sector where if you're wrong, your overall portfolio is down 30 or 40 or 50%. I've got lots of individual stocks and recommendations that, go down 50% for a while. If I still like it, I tell people to double down. But if the thing goes bust, your whole portfolio isn't bust. And remember that these things can be fleeting. I mean, do you realize, Charlotte, and not to belabor that, last year was 2025. You know what happened in the middle of last year for gold stocks?
Remind me.
They got back to their peak from January of 2011.
Wow.
So it took 14 years. For a lot of religious gold bugs, they were excited at the peak of the market in 2011, rode the sector down, rode it back up. 14 years of wasted money and opportunity in between. Finally got to even last year, and then better than even because things kept going. But now we've given back a lot of that in the recent past. And so that's why it's important to not be dogmatic about anything. Don't be religious about precious metals, but understand these things in the markets and how they impact gold and silver, as well as other things. And again, I laid out earlier in our conversation what you're going to have to see for those generalist investors to come back in. And regrettably, it's not going to be next week or next month quite yet.
Well, I think that's a great note to end on, and definitely we are in uncharted territory. So thank you for coming on to help us make sense of at least some of it. This was great.
Always a pleasure.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Chris Temple with the National Investor.